Well, let's go ahead and start. This is John Yates, and I chair the technology practice at the law firm of Morris, Manning & Martin. And it's my pleasure to be here today with two very fine companies, and we'll learn more about them in just a second. And in particular with our really the key fund that's helped to drive this particular program, and that is our good folks from Kayne. And Harrison Brunelli is here with us today, along with several of his colleagues from Kayne. And I thought it would be appropriate for us to start out with a little overview from them. And we're going to then move into a quick overview about Azalea Health that Baha Zadan, the CEO of that company, will give us. And then I'm going to ask Craig at FreightWaves to give us an overview of his company. Very interesting businesses, both of them. And then we're going to jump into a series of questions. And again, these questions are going to focus on key issues and drivers for how a technology company can grow rapidly through acquisitions. As you'll notice, the title of our presentation again is Making Acquisitions During the Pandemic, How to Grow Your Tech Company in 2021. Now, we came up with this title, and I think our good folks at Kayne were the ones that maybe originated it. We didn't know how long the pandemic was going to last. We all hope it ends soon, but the reality of it is I think we're living with this for a while. And at least some of the pundits would say through 2021. So this isn't one of these things that's going to be short-lived. And also a lot of the advice that's going to be given today will be very relevant even post-pandemic. So with that, Harrison Brunelli, could you give an overview of Kayne Partners Funds and maybe a little bit of background about the areas of focus for the fund? And we thank you again for your involvement.
Yeah, no, good morning, everybody. And thank you, John and team. Can everyone hear me all right?
Yes.
Perfect. And thanks to the Morris Manning team. You guys have been a great partner for us in Atlanta and in the broader Southeast, and it's great to see a number of Atlanta-based companies and broader Southeast companies here today. I think for Kayne, we've been focused on this region for quite a while and think it's, a strong technology hub that's only going to continue to grow. And we have a couple of our great portfolio companies on here today, but, we have a couple in Atlanta and several more throughout the broader region. And so, I'll start by giving you guys a high-level overview on Kayne and who we are and where we focus. I think the topic today is really relevant in terms of how we look to partner with portfolio companies. And it's a common theme across our firm, which is partnership. And so, there's no kind of coincidence that partner is in our name, and that's really kind of how we think about things. So, Kayne Partners is the growth equity strategy of a much broader firm, which is Kayne Anderson Capital, which is about a $30 billion asset manager headquartered in Los Angeles. And we've really been investing and operating since the mid 80s, really with a common focus since that point, which is identifying attractive niches and verticals where we can bring our sourcing and knowledge advantage, and also the resources and connections of a large firm to partner with companies in those spaces and give them an advantage and help them really drive their growth. And so if you look at Kayne Anderson today, there are four main strategies: energy, real estate, credit, and growth private equity. And so the growth fund, Kayne Partners, where I sit, really got its start coming out of the early 2000s, coming out of the dot-com bubble, where there really was a lack of focus on investing in B2B focused technology businesses. There was a lot of hype around consumer companies, but there weren't a lot of institutional investors that were spending their time with growth stage B2B focused companies. And we saw a big opportunity there to really partner with proven management teams that had a proven product market fit, and provide them with capital and expertise to really grow and scale their businesses. And we've really been focused on that stage of company since around 2002. And so really, the way we look at it is we really think of ourselves as stage-focused investors who are kind of building an expertise around the challenges and also the opportunities that companies at this stage are facing. And so, whether you're a technology company selling into the healthcare vertical like Baha at Azalea, or selling into the supply chain logistics vertical like Craig at FreightWaves, we tend to find that these businesses are facing very similar challenges and questions, whether it's how do I build out my enterprise sales team? How do I think about key executive hires? M&A, which is an area we're going to touch on today. And so we really try to be that kind of strategic partner for businesses that are at that inflection point And we bring our capital, but also our knowledge around these topics and the resources of Kayne Anderson and the network that comes along with that to really drive value. So we're typically investing anywhere from 10 to call it $75 million for the most part on a minority non-controlled basis. And we are looking to partner with management teams that are looking for someone who can help them really drive that growth forward and help them on that path towards whatever that eventual exit is. So, with that, I will turn it over to Baha and Craig and let them get a little bit more on their firms and where they focus.
Harrison, thank you. By the way, before we jump into that, this is to give you an idea of the breadth of the Kayne portfolio, and very impressive. And it's also great that it's a very interesting fund. The folks from Kayne also have a unique ability to be able to write checks of varying sizes, from smaller checks all the way up the line. So it's quite a unique company, and you can see here the portfolio companies they've invested in. And as Harrison said, one of those companies is Azalea Health. And so we're very, very pleased to have Baha Zidan with us today, the CEO and founder of Azalea. So Baha, if you could give us an overview of the company, that'd be great.
Yeah, thank you, John. It's been an honor to join you today. And thank you, Harrison, for a great partnership with Kayne Anderson. Azalea Health is a health IT company. We mainly focus on providing a cloud solution for small to mid-size physician offices and small to mid-size hospitals. And we feel that that segment is underserved with cloud delivery when it comes to software. And Azalea is positioned itself to be the only cloud multi-tenant solution for a small health system at this stage. And we've been growing fast. I would say right now we should end the year where, since the partnership with Kayne, Azalea has grown 5 times over the last 4.5 years. So it's been a great partnership with Kayne. And also I'll mention another caveat that Azalea has done 3 acquisitions in the last, I would say 6 years. And we got to learn a lot. And we've done a lot of great things, and we made mistakes, and hopefully we'll share some of it today.
Well, we appreciate that, Baha. And I think, frankly, the greatest lessons to be learned, and since I know just about everybody on the Zoom call today, I can tell you that we've all had our fair share of mistakes, but we've learned from them. And so it's great to be able to have your insights. The growth of your company is quite impressive. And I might say also that Baha learned about this industry because he started in the industry. Baha, take just 1 minute to talk about how you started this company, because Baha is far too modest about it, but he actually came to this country with probably nothing more than a couple nickels to rub together, and then ended up in Valdosta, Georgia. So give us just a real quick overview of how you ended up building the company and understanding the market.
Yeah, well, thank you, John. As you mentioned, Valdosta is where I went to school. They were crazy enough to give me a scholarship for a computer science degree. And actually, it's the benefit of internship. I was interning with a medical laboratory company, which later on worked full-time, and they sponsored my visa since then. And got to understand how there's a big need for the healthcare industry to digitalize and automate and bring cloud to the forefront of the industry. And that was in the early 2000s, and started the company in Valdosta with 2 other co-founders. But actually an acquisition moved me to Atlanta, and it made my life a lot simpler. Instead of coming in here trying to find real estate, build out a team, with one transaction, we had a headquarter in Atlanta, we had a sales team in Atlanta, and we were able to kind of start running with our presence in a large city like Atlanta. It's been a great run, and it's been an interesting ride.
Baha, we appreciate it. Thank you for being with us today. We're also very, very pleased to have Craig Fuller with us, the CEO of FreightWaves. And Craig's company is in Chattanooga, but they've really created a national presence in their market. And many people may not be familiar with FreightWaves market, but Craig, tell us a little bit about the company and how you built it and what your area of focus is.
Yeah, so the joke that people talk about FreightWaves is as if ESPN and Bloomberg had a baby in the back of the semi, I think is the best way to describe it. Is effectively what we're doing is creating a data business that provides a lot of context through media about what's happened in the $9.6 trillion logistics industry. So you've got the sort of entertainment component of ESPN where it's very lighthearted because it's a blue collar industry with, it's a high pressure industry because effectively the logistics industry is responsible for really maintaining the global supply chain. And so there's a lot of pressure on it. So we try to take a lighthearted element to our content. And then effectively Bloomberg has got data products that they provide fundamental data and analysis for the global financial markets. And that's been largely our inspiration as we built out Freightways. So we have an editorial group that's about 50 folks total, which includes content and journalists. And then the balance of the company, which is about 100, is involved in the data product, our Sonar product, which provides real-time fundamental data to companies to make better and more effective pricing decisions, mitigate risk, and basically run their supply chains more efficiently and more cost effective. So the reason we exist is that most of the routing decisions that are made in the logistics industry are routed within 48 hours, as people are not making long-term decisions that are 6 months to a year out. They're making these decisions in a very short time frame. And so because of the volatility of the market, whether it's capacity or price, they're required to respond to those elements and in a real-time basis. And so what we're trying to do is help speed up the flow of information so they have context and information right now. And with that, give them better forecast and analytics about what's likely to happen along with context.
And Craig, I think you have the slide that talks about content as a service. It's an interesting rubric that you've come up with, but that probably describes pretty well what you're doing is, in this area too, right?
Yeah, so we think of we have a large news, about 65% of the world's logistics news traffic comes through freightways.com or our podcast and video cast over top streaming TV. And so we're providing a lot of content and context to the market. But we also, because we have this very large audience, we get approached by companies that are in the industry, either trying to sell technology services, perhaps a law firm, perhaps an insurance company, a bank, or a technology vendor that services the logistics industry is trying to reach the same audience that we are through our data. And they come to Freightways to help basically provide advertising and marketing content. And it's become really relevant in a COVID world because most of the customer acquisitions and engagement were done through relationships and logistics. And because of COVID, they've been forced to actually invest in the ongoing digital engagement, the video engagement, the text engagement, and so forth.
It's great. Let's jump in real quickly, and Baha, maybe you can give us a little idea about some of the acquisitions you've made there at Azalea and what drove them. What were the benefits associated with them? And bear in mind that we're going to ask you in a few moments about what were the challenges, the things you learned out of it. And then I'll ask the same question of Craig. So why don't you start out? I think you've got a few acquisition examples here.
Yeah, so I mean, thinking about acquisitions in general, the way we think about acquisition is, there's three reasons any company goes after acquisition: either access to talent, access to more customers, or access to new markets, or a combination of those needs. And in a way, the first transaction actually, when it happened, it was a combination where we accessed talent, accessed new location for the business, but also accessed new customers. So it was a competing company that was in the market. That regulatory environment kind of became very challenging for them to stay up to speed. So we were able to, however, they had great sales team. So it checked a lot of boxes where it kind of accelerated Azalea, and it made us sprint forward where we didn't have to start from scratch building a sales team and sales processes. We didn't need to start from scratch building a headquarter in Atlanta. So that was the purpose of that acquisition. And actually, we were able to upsell some of that customer base and create a lot of financial synergies from that acquisition. The second acquisition that we had, and actually it's another competing company that was in California, and oddly enough, it was our first application Azalea used as for one of our customers. So we were users of this product, and over the years got to know them really well, and we understood that there could be an opportunity for us and to acquire them. And one of the key benefits from that acquisition is growing our SaaS revenue. So we were able to do that. Not only that, but also be able to expand our revenue per customer from that acquired base. We have learned a lot from the first acquisition, where we took customer base and moved them to our platform. We decided early on not to have multiple platforms supported by Azalea. We got to focus on one core product, one core platform, and as we do acquisitions, we'll migrate those to the platform. We did that actually the first time, and the second time we did it much better because we put a much more rigid timeline for the company and the customers to achieve those synergies quicker. And I'll pivot to the third acquisition that Azalea done. Thank you, John, for moving through those slides. The third acquisition is more of a strategic acquisition. We realized after listening to our industry, after listening to our customers, after understanding where the long-term horizon of the industry, that to be relevant, we need to be providing solution for the ambulatory side, the physician office side, and the hospital side. And we felt this acquisition will give us a head start in being in the hospital side. So this is a strategic acquisition, and in the strategic acquisitions, the benefit of the acquisition can be unlimited versus an acquisition where you're acquiring a customer base. Your success is depending on the migration of the customer base. However, an acquisition like Prognosis, which is a strategic acquisition, what I would say, the sky is the limit. We now opened a new market for us. We're able to sell more, sell higher dollar monthly recurring revenue sales, and allowed us to also boost our ambulatory product with additional sales on that side for some of the customers who came from Prognosis. Those are the key acquisitions that we've done, and we'll be glad to talk about pitfalls and things to watch out for.
Let me ask you this, Baha. How did you find those companies, and what role did your investor play? The investor is sometimes called the financial sponsor, by the way, for those folks on the call. If you hear the word financial sponsor, it basically just means your investor. But did you find them yourself, Baha? Did they come to you?
Yeah. So I had a theory early on in my life that I always should be recruiting and I always should be looking at acquisitions. So both the first one and the second one, they were competitors that I've tracked over time and continue to stay in touch with their CEOs. And quite frankly, at any given moment, I have portfolio of CEOs that I'm constantly in touch with for opportunities like an acquisition opportunity. But also sometimes our customers can lead us to those opportunities for acquisitions. And quite frankly, Harrison and Lauren have been helping me also kind of work through identifying possibilities in the marketplace. So how did Kayne help, or our financial sponsor help? Quite frankly, it was very helpful during our diligence for the strategic acquisition. The company did that acquisition only about 6 months after LeonardoMD acquisition. So the company was really busy with the migration. We had a lot of needs at that time for deep dive in the diligence side. And I remember the moment one of Kayne's associates, I met him in Houston, and he literally printed and read every contract Prognosis had and highlighted everything that I need to be watching out for. This is the kind of bandwidth that a financial sponsor like Kayne can provide to a small company like Azalea. And that's extremely helpful.
So I'm going to come back to Harris in just a second, but let's first dig into and get Craig to tell us about the similar sort of acquisition strategy that was followed on his part. So I'm going to pull up a slide here, Craig, that sort of walks through that strategy, where it'll get you to walk through that strategy and tell us a little bit more about how you, how you ended up building the business. So walk us through that strategy for FreightWaves.
Yeah, so I would say we look at acquisitions from two primary veins. One is what I call valuation arbitrage, which is we're a SaaS business that trades at technology multiples, and we're looking for businesses which don't trade at the level that we do, or perhaps are. The issue is in a lot of these technology businesses or media businesses that are subscale is they may have a large part of their market or their respective market, but they also can't scale because they can't scale without our resources. And so one of the advantages we have in the market is we have a very large distribution, both organic through our media, but also through our distribution of our data product. So there's a lot of, when we're looking at potential acquisitions, we're looking for companies that have an interesting product portfolio or tangentially connected to us, are connected to our SaaS business. And so maybe they are representing a different part of the market, or maybe they're tracking data sets that they're the leader in their market. So one company we bought was a benchmarking business, which we can talk about in a second, that takes in benchmarking data from about 260 trucking fleets, about 70,000 trucks, and had really deep general ledger and financial and operational data that was really interesting for our audience. And really they had scaled to a point where it was very difficult for them to go. It was a 4-person operation. It was very difficult for them to add additional clients without really upgrading their sales motions. So we were able to acquire that and put it into our distribution strategy, which made a lot of sense. But there's also a pretty significant valuation arbitrage here in the market, because a lot of these businesses are not going to get the turn in multiple. They don't have the growth that we have, and they don't have the scale that we have. And so those things give us the ability to buy a business very efficiently, oftentimes for EBITDA. And so you're thinking about buying a business to 4 to 6 times EBITDA, but we're trading at, depends on the day and the perspective, but we'll say 10 to 20 times revenue. It's a very different perspective on how people would value us. And for that reason, you don't want to do it just for valuation arbitrage. That's a sort of a benefit of doing it. You want to make it connected, and you want to make sure that we can bring resources and help scale the business organically through our distribution. So one of the things that we've done really successfully is acquire media businesses. Examples, American Shipper. It was a print publisher that had really made the transition to digital. So the business was the number 2 player in the global trade, global ocean media business. And basically we were able to cut their cost by 75%. And for what we paid, I think it was 5 times EBITDA. Within 18 months, we basically paid for the entire thing. And the advantage we had was we'd taken a print publisher, basically ditched their entire infrastructure, all their content transferred, a couple of the journalists transferred, and the domains transferred, but we got rid of everything. We just scuttled everything else and then moved everything to our content management system. And what that enabled us to do was really grow the traffic, because in a digital world, Google and Facebook and LinkedIn are really the king makers. And the nice thing is FreightWaves is ranked and rated really high and respected by those search engines. And for that reason, we get a lot of organic lift when we did that. In fact, when we transferred the traffic, within days, the traffic exploded. They had never gotten, I think it was over 18,000 page views at a day. And within the first day of when we made it transferred to our content management system, they haven't dropped below 18,000. And so some days they're getting 40, 60, 70,000. And so it is now the largest ocean trade publication in the market. It beat out the number 1 player, and basically we were able to cut about 75% of their editorial costs because we were able to bring it in-house and really sort of optimize the model.
Craig, I think this chart shows what you want an acquisition to do in the way of impact on a company here as far as monthly visitors. This must have been a dramatic upswing in the business and must have validated the fact you made a good acquisition.
Yeah, the media acquisitions are interesting because a lot of them have not, particularly in the B2B world, have not made the transition towards digital. And they don't, first of all, they don't have the DNA to do it. And then they don't have the dollars to make the investments. The nice thing about media properties is they're actually quite easy to, unlike data businesses or software businesses or physical businesses, it's very easy to take their content and transfer it to our digital content management system, because that's effectively what you're doing, is serving up content. That's very easy. It's more difficult, as we saw in another acquisition, to transfer a data and software product, because that requires a lot more infrastructure to invest. But if you're just transferring content and editorial, that's a totally different game, and it's quite easy and efficient to do so. So this is another example of an acquisition we did. We haven't actually made this public, so you guys are the first folks outside of our investor group and board that's aware of it. But we bought it. It was an acqui-hire. It was a company that was basically I think of it as a passion project for someone that the ELD mandate, which is the electronic logging mandate, came into effect 2 years ago in trucking. There was a CTO at a trucking company that was trying to figure out which electronic logging device he wanted for his company, and realized there was no rating site in trucking. And so he went out and created this product, and the mandate is over with, and the business is sort of maxed out in terms of what it can do. But we also wanted to move into ratings. And so think of it as an Edmunds.com or a Consumer Reports. I think that I might have forgot to finish my sentence on the build an Edmunds or a consumer on that. But basically a Consumer Reports or Edmunds.com of the commercial trucking industry. And so this was effectively, think of it almost as an acqui-hire, even though we weren't hiring people, as we were ingesting the software into our platform. And then we're basically just building the whole wireframes and arrangements around it. This is a media acquisition with some data components, and we like that. And then the last piece is just what I've discussed, is what I call tangential data businesses, which are companies that have a lot of data, have software, have distribution, and perhaps are the largest in their market. A lot of data businesses have one data set or two data sets where they're the leader. They sort of own all the data in that market. In our market, there aren't companies that aggregate data across really the whole marketplace. They tend to be very, very, very specific to what their data is trying to track. And we do the opposite. We go across the entire marketplace, and then we use artificial intelligence and machine learning to marry up these data sets for better forecasting. And so we're looking on a consistent basis of data sets that we can acquire, or companies that have data that we can acquire. Oftentimes we just buy the data stream. And so we're not actually buying the company, we're buying the data of the underlying product, and they continue to do their thing. But we're still, often looking for companies that have data sets that can be complementary to our core.
So Craig, how did you find these companies? How did they, and how do you see finding other companies in the future? I think a lot of folks that are on this Zoom today are interested in maybe making acquisitions, but as Ba talked about how he found them, how do you find these companies?
Yes, one of the advantages I have is I have a media business. And so we have journalists that are doing research, that are tracking the market. And because we sit in the center of a community, if you will, we know what's happening. Actually, if you think about it, because we have journalists, they're doing a lot of diligence on a consistent basis. They're diligencing the market, and so that gives us an advantage because we're visible. We're in the market. We know a lot of the players that are in the market. That gives us a real distinct advantage. And then also because of our presence in media, it means that when we reach out to CEOs that run these businesses, oftentimes they return my call. So I've been doing most of the outreach. If we see a business that looks interesting, is typically whether I may not be the first call to a company, but once it's a part of our radar, I tend to want to develop the relationship with the founder, the owner, the principals, because I think that's important because they're ultimately selling their business to a company, and we want to build that trust with them.
Right. So let me ask Kayne this question, because one of the things, a lot of the folks that are on this Zoom meeting today, as I mentioned, I know a lot of these companies, many of them do not have outside institutional money, but they're growing rapidly. And I'm wondering, Harrison, from your standpoint, talk about what role the investor plays. Bah, you've already alluded to that. They've played a key role in diligence, but what's that fine line, Harrison, between helping out and being annoying, with regard to acquisitions, and how do you make it work?
Yeah, so I would say one thing that we've seen as a common theme across the companies that we meet is that a lot of companies that are, call it 10, 15, 20 million of revenue, think that they're too small to be doing acquisitions. It's not really something that's on their radar. They think we have to be, $100 million revenue business for an acquisition to be doable for us. And so what we try to educate a lot of the companies we work with on is that, even if you're a growth stage company, you're still relatively early on in your growth trajectory. There are a lot of interesting advantages to M&A, and it's something that if you approach it in the right way, it can really get you where you want to go faster. So that's how we really think about it. And so we're never in a position where we're pushing it on our companies, but we certainly try to give them ideas around, here are some interesting areas from an ideation perspective of that we think could be interesting for M&A. So we're very collaborative in terms of just helping them map out the market, think about what are the different segments that they could be looking at, whether it's more product expansion, getting into new markets, or expanding their share in their existing markets by going after kind of more direct competitors. And so we can be very helpful on that front end of mapping out the market, also doing a lot of the outreach. So what we find is that if you're getting inbound from one of your competitors, you may be much less likely as a potential M&A target to take that call or want to divulge as much information. But when you have an investor group reaching out to you, it's a little bit more comfortable. It's a little bit more of a third party neutral point of view. And so they might be much more willing to hop on the phone, share some information about their business. And so we really view ourselves as that first layer of trying to vet a lot of those opportunities. And then as we get further along in that process, we also try to be helpful in terms of providing diligence expertise, also thinking through how you negotiate and structure a lot of these deals. And obviously, John, you and your team are experienced in a lot of this as well. And there's a bunch of different ways you can structure an acquisition. And so we really try to help our companies think through what's the best way of optimizing the outcome as you're negotiating, structuring the deal, and then really try to bring our expertise around business due diligence and financial due diligence and try to be a partner with our companies as they're working through that as well.
So Harrison, would you suggest to a lot of the companies here, and many of them, again, don't have institutional money. They, Bah and Craig have done a great job of sort of integrating with Kayne, but should every board, even for these companies that don't have institutional money, should there be a line item there at a board meeting, potential acquisitions? I mean, does that make sense? Is that something they really should be thinking about, even in an early stage?
Yeah, so I think when it depends on the stage of the business. So I would say, if you're really prior to that point of figuring out product market fit, you're still kind of getting through, building out your core product and your core customer base. Up to that point, acquisitions are probably a little bit of a distraction. But once you're at that point where you've really kind of figured out product market fit, you have a strong customer base, I think it's important to start being mindful of the opportunities that are out there and in starting to build those relationships, because as Craig alluded to, a lot of it is very relationship driven, and so it's helpful to start getting to know potential targets, because it might take 6, 12, 18 months before they're in a position where they necessarily want to be acquired. So we think it's definitely something that companies should be thinking about. And it's also something that if you are thinking about raising capital from an investor, if you already have a list of, hey, these are M&A targets that we think can help accelerate our growth, it's actually really helpful for investors, because that's somewhere where we like to put our capital. So to see a company thinking about that, one, shows us that they're very strategic and know their market well, but two, it also gives us a very clear vision of where some of our capital can go to help accelerate their growth. So we definitely think it's something that should be part of the conversation. Now, I think at the end of the day, right, this is just one growth vector. So I would also caution people, don't, overemphasize M&A, because you still need to have a strong underlying organic business. But it is definitely something that I think is underrated and underutilized. And we would definitely recommend that companies have that as kind of a key part of their board conversations.
So Baha, let me ask you a question. One of the issues that came up here, you talked about, and I think Craig talked about this as well, is approaching these potential targets that you may want to acquire and building the relationship there. And in particular, understanding more about the company culture and maybe the customers and the like, and how do you have that sort of mating dance occurring early in the process, and how do you get information that gives you a determination as to whether they go to the next step?
Yeah, entrepreneurs who are selling their business, they're very emotionally attached to the business. So they want to have a level of trust from the buyer or the prospect of who would buy their business. Quite frankly, in all of our deals, the previous discussions were soft introductions, just so a peer-to-peer to get to know each other. One of the acquisitions, the CEO is the founder, who's a physician. He is so passionate about his customers and employees. He was willing to take a much lower multiple to make sure they're in a safe place and a better place versus just a higher multiple to exit. So I think that connection and soft introduction, either, and I'm talking back again, this how we source deals, constantly thinking about, would your client can introduce you to them, would a sponsor like Kayne would do it, a trade show, leverage your own leadership team who may have relationships in the industry, as well as bankers. By the way, probably Harrison attests to this. They get a lot of deals also from bankers. We get some introductions from investment bankers where they probably will not be interested in presenting that deal. Maybe it's too small for them, or it's not something that they want to focus on. So they will make a lot of introductions. So having a relationship with bankers is a key, as well as your partners. Matter of fact, one of the great deals that we're looking at, a partner of Azalea came to us and introduced us to them. So those are some of the key steps to move the deal forward.
Hey, John, I'm still here. I lost video.
That's okay.
We're trying to experiment. The thing about having a media business is you end up trying to test new things. So this is a setup that I haven't tried before. So we'll try to get video restored here in a second. So
that's okay. We remember what you look like. But Craig, from your standpoint too, I wonder how important culture is for you when you were talking to somebody, maybe trying to think about making an acquisition. A lot of it you're buying, in some instances, sort of data, intellectual property and other things. But how do you gauge that determination as to whether you're going to go to the next step when you're talking to a potential target?
So I think, we're looking, we know what we want to acquire. And I think oftentimes we have a lot of visibility as to the types of businesses we'd like to acquire. One of the things, I want to back up one thing to shout out to Kayne and Harrison and the team there, is that they're actually sourcing deals. And what they're seeing is typically what I would call later stage deals, companies that aren't just going to pick up the phone and start having a conversation around acquisitions day one. These are I would call more aspirational type acquisitions versus sort of these evaluation arbitrage, where companies are going to trade at similar multiples than ourselves. And so, you may be able to build a relationship, but certainly the initial conversation isn't going to be about acquisition. You're going to have to really get to know those founders for a while, or they're going to be in a process, and that typically doesn't come to us, that comes through Kayne. And that's where we see sort of the source deals, the investment bankers hired. There have been other situations where I've identified a business I want to acquire and I can't get a hold of the CEO or can't get a hold of the founders, can't figure out how to navigate their corporate structure. That's where I'll send Harrison in. And what's nice about it is you basically have an investment banker built into your cap table. And if there's anything that investors bring you, they bring you a level of sort of analysis. We had one deal, 2 weeks ago, where I said, hey, this business I know is in motion. And Harrison and team were able to vet that deal really quickly and come back and say, hey, this is the valuation they're asking for. it's sort of ridiculous because so at that point, for me, I'm not going to waste my time. And I agreed with them after they told me the numbers, but I do think there's a lot of value in having that relationship that probably is underappreciated. Go ahead, John.
I mean, it also sounds like you have your sort of in-house VP of business development built into the model with having an investor group like Kayne. They can go out and do that.
For sure. And I think because of the scale and the team, and frankly, we've become very comfortable with Kayne. I think Baha alluded to this, is they're thorough. They were thorough to us in our diligence. And while that process could take a lot of work, particularly in a COVID world where you're doing it remote, I think they're also bringing a lot of value. And I think what's comforting is now that they're on our side of the fence. They're going to fight for us, and they're going to do the same level of diligence on any acquisitions that we may want to acquire. So they're going to keep us from making mistakes that maybe we wouldn't that we would have otherwise done.
So Harris, I don't want to ask you a question here. One of the acquisitions I think, Baha, that you made was a situation too where there was already an investor in the company you were acquiring, and I'm wondering to what extent the investor, the Kaynes of the world within these companies, that you have an ability to sometimes look at a company and say, look, Baha, Craig, this could be a really interesting company. And we know that this fund that's investor in this target company, Target X, this venture fund is getting ready to go out of business, or this is a deal they really got to get rid of. And, you ought to attack them right now. Information that frankly, most of the entrepreneurs in this call don't have. I mean, is that information you have as well oftentimes, and you can help to guide and direct?
Absolutely. I mean, one of the things that most companies in our size, they wouldn't have, for example, a subscription for PitchBook or that level of insights. And that's the level of insights a sponsor can bring to you. And, and like Greg mentioned, leveraging them as your biz development, or you mentioned it as your biz development arm. Yeah, definitely.
Yeah, what I would add to that is, we have an outbound sourcing model for our investment strategy. So we can very easily leverage that capability on behalf of our portfolio companies. And so our sourcing model is everything from directly reaching out to companies to maintaining relationships with other funds, to maintaining relationships with bankers and other intermediaries. And so it's very easy for us to leverage that effort on behalf of our portfolio companies and identify opportunities for them. And John, that scenario you mentioned is actually something we're going through with one of our other portfolio companies right now, where it's a venture fund. They've been in this company for a sustained amount of time. They're looking for an exit. So opportunistically, we started having conversations with them around, could this be a good fit because you guys are in the same industry? We have a larger platform here, and that venture fund is probably going to continue to actually participate in the combined entity, and it kind of creates a nice exit opportunity for them, and it's a good kind of add-on acquisition for our portfolio company.
That's great. By the way, I'd mentioned to our audience, please feel free to engage in chat. Send me a chat, and we'll make sure to ask questions there too. So the statistics, if you look at successes and acquisitions generally, and this is the general statement, and you survey the market, the question is, how successful are acquisitions generally in growing a business? And the percentage is often very small. It's like 80% of them don't work out. Now, it's probably different in the technology area, but I'm wondering, both asking Craig and Baha this, and then getting Harrison's input, what could go wrong, right? I mean, in this situation, and if you're thinking about sort of the biggest problems and concerns that people on this call should have if they're thinking about doing an acquisition, what are the sort of 1, 2, or 3 things that are really, really important to get right? Or if you see them going wrong, you want to go fix them. So Craig, you talked a little bit about some things. What are those areas?
Yeah, we bought a software business last year, and it was really a small company. At the time we bought it, had 4 people involved in it. And basically the founder stayed, but he was real critical to the operations. And when he didn't hit the targets that he had set out for himself, and realized that he wasn't going to be able to get, as much of the earnout as he had thought or planned, he became very, I think, disenfranchised and frustrated, and ended up basically leaving the company. And so now we have this asset where it isn't fully integrated into our product. And he was a critical component of the relationship with the customers that basically we're now having to rescue, if you will. And I think that wasn't, and look, he left on good terms and he actually enjoyed his tenure here, but I think he just, as a founder, you have a lot of pride in what you're doing. And I think he didn't, it was sort of a way for him to exit without, it was disappointing, frankly. So, but I think if you lose the founder in a founder-driven business or a really small business, that creates a lot of risk. And so I think if we're buying a media business, it's easy. You don't want to buy a one-person operation, but you can buy a couple because you can sort of ingest their content and their coverage. If you're buying a software product, then certainly you want the founder to stay around. And one, a very small company like that would create a lot of risk for us.
So Harrison, let me ask you a question in that regard. I mean, building in earnouts and incentives and performance criteria, that's tricky in that situation, right? Is that kind of guidance that an investor can provide too in that regard?
Yeah, for sure. So I would say with almost all of our acquisitions that the portfolio companies are making, there's going to be some sort of performance-based component to make sure that incentives are aligned post-acquisition. And also in a lot of cases, we are encouraging our portfolio companies to provide maybe some small piece of equity to the principals in that business to make sure that they're bought into the vision, if we think that it's critical to have them there in a case like Craig is talking about, making sure that they either have some equity or some sort of incentive plan to make sure that they are really kind of bought into the vision of the business going forward. And I also think a big part of it is just the people component of it. I think that's one of the biggest risks around acquisitions is, if that person doesn't feel aligned or doesn't buy into the culture of the company, and and you're thinking they're critical to be part of that company. And look, you obviously can't predict that in every case, but I think that's why it's important to spend a lot of time up front getting to know the principles of the business and kind of making sure that they really feel like, hey, we buy into the culture and we see ourselves being a part of this bigger platform. But I do think structure is a big part of that, right? Thinking through earnouts and giving equity. But I also think a big part of it, as much as things, a big part of it is just the people. And that's why I think we encourage a lot of our companies to spend that time up front getting to know those founders and making sure that if they think they're critical, then they're going to continue to want to be a part of the company going forward.
I think a good takeaway here out of the discussion with Craig and Harrison is the fact that earnouts performance criteria are really important to focus on. And it's very hard to determine and create those in a way that actually work. I mean, a lot of them do, but I've been doing this 39 years and a lot of them don't. So getting that kind of input. So Baha, from your standpoint, what were some of those key issues there that you think about, some things that are really drivers?
Definitely. I don't want to sound repetitive, but in the technology world, we feel like we can fix anything with technology, but you can't fix people. So people is a great key when it comes to acquisitions. So making sure you're aligned with them, they fit the culture is important. But one of the things I will mention after the integration of that culture into the existing team and having less intimidation from the buyer and the acquired team, having them both built and be on the same team and communicating to them in a prompt way is a key. And having also transparency does help with making sure that team is bought in. The worst thing they could feel is that they are the acquired team and they're in a black box, and they create a lot of conspiracy theories, I would say. So having them having a seat at the table, be able to expose the overall strategy and make them part of the platform strategy is a key. Another thing I want to mention, as one of the key things that you always look back, what could we have done differently? Entrepreneurs traditionally, we make decisions quickly, and with a fast velocity, and maintaining that even during acquisition and post acquisition during integration is a key. I mean, if you look at any mistake I've done in the past, it's because I took too long to make that decision. I knew it, but I was like, I don't know that industry as well as they do. So I'm going to continue to give them hope, give them more time. And quite frankly, making quick decisions in that stage is just as important as when you're building the business as a founder.
So let me ask both of you about customers and integration and migration and giving customers comfort, because obviously that's a big deal in the diligence process. Harrison, I guess you guys talk about the target you're talking to. They're trying to talk to some of their customers. How do you make the integration piece work well? And Harrison, does it really start from your standpoint when you're working through the diligence and maybe making customer calls on the target customers?
Yeah, so one thing that often surprises us is how often companies don't do customer reference calls when they're making acquisitions, which, it's something that for us, when we're making investments in businesses, it's a key part of our diligence. And Baha and Craig will both attest to this, that we like to talk to, 10, 12, sometimes 15 of their customers, because to us, that's really, especially with a software business, that is the critical component of what you're doing. And it's really invaluable to us in terms of determining the quality of a business. And so same thing goes for acquisitions. We really think it's important to spend time talking to their customers, making sure that they are really bought into the product, the technology, and have good things to say about the team, because that's going to be their best references. And so one thing I would recommend is don't just talk to the customers that the target recommends. Ask them for a list of their entire customer base and just pick random customers. And that way you'll get a true sampling of, what customers actually think, and also talk to customers of all sizes. So don't just talk to the big customers that they might be focusing on the most. Talk to some of the smaller customers as well and see, are they giving them the same level of service as those bigger customers? And oftentimes, if you have those conversations and, 8 out of 10 of them are very similar and are saying positive things, it probably bodes well for that company and the quality of their product.
Craig, your thoughts on that?
Well, I'm learning how Harrison operated our deal. So we're doing this sort of covert analysis on our customers is reassuring to know that they do that. I would agree with that. I mean, I think it also depends on, it's important for us if we're buying, we have a well-known brand in our industry. So the acquisitions we've done, and I think the acquisitions that we've got teed up to do, we actually have higher brand equity than a lot of the companies we're buying. Now, they may have an area of the industry that we're not as well known. They may be the leader in their sort of respective markets or have data that's in their markets. But oftentimes it's very easy for people to identify us because we have such a big brand presence. And I think for us, because we typically are upgrading a lot of the, on the media side, certainly upgrading a lot of their infrastructure, that is reassuring to those customers because they know that we're making investments. The thing that we emphasize is we're not buying this. You think of like a lot of acquisitions as buying it, you're laying off people, you're sort of consolidating operations. For us, it's the opposite, is we're actually buying it and making significant investments. Now, we may find cost synergies as I've identified, but we're actually, whether we're making significant improvements and investments to their infrastructure. And I think that gets customers really, really assured. So for us, it's communicating our strategy, being transparent about what we're planning to do with the business. We're very open about our strategy, and I think that gives customers a lot of comfort and, frankly, a lot of confidence. I think one of the mistakes that I see that when we report on companies outside of FreightWaves is they tend to want to be very sort of cagey about what they're going to do with the business. And I actually think when you're talking about a big transition with customers, particularly software products, that actually creates more anxiety, because whether they get that anxiety from you or whether your competitors start to create this anxiety in the market, I don't think that's helpful. So I think being transparent, communicating your strategy with the customers, and frankly, the media, is being open about what you're planning to do with it, will quell a lot of the sort of gossip that happens out there. I mean, we hear it because we have editorial, we hear it all the time about so-and-so company's going under, so-and-so company is really struggling. This acquisition was done for this reason. And because we have an editorial group, I would say out of 100 rumors, we find out 5 of those are true. So some of them are really juicy rumors, but they're fake. And they're created because the company itself is not transparent.
So this is an important topic, and I think a lot of the folks on this Zoom call are focused on this too. And Bao, you made a good point of saying that, you know, as you brought other companies in, you basically try to migrate them to a common platform. I remember a situation years ago. We had a client that did 12 acquisitions in 24 months. They ended with 150 different products. And then one day the CEO called me and said, we're going down to 20 products. So we had to sunset 130 products. Those are some pretty bad letters I had to send out to people that they were no longer going to be supported. What kind of a challenge is that? And would you recommend that people really stay on one platform?
I do, just because, you know, I know even multi-billion-dollar companies in our space like McKesson had a hard time maintaining multiple products targeting the same segment. Even they found themselves over the years, and some of the sales reps in this product were competing against their own sales reps on this other product. So it wouldn't make sense. But going back into communicating to the customers, you know, after the first acquisition, we were very intentional to have well thought out plan, communication plan to be discussed with the clients. And actually, because, you know, we're moving their information from one platform to the other. So it's not an easy task. It's just like you, John, if Morris Manning moved their law software from one platform to the other, and now, you know, it's a lot of work. You gotta have to be thinking about timelines for your own business, more or less than the vendor. So having a crisp, clean communication plan that is deployed to our customers, where day one, here's what we're gonna say, day two, day three, and all the way to the final stage, which is the sunset, and sticking with this plan. Because one of the biggest problem is you're gonna find people that they want to drag it another 6 more months or another 5 more months, and they can, you know, moving them to our platform and just not sticking with those timelines can be detriment to the business. Because, you know, the reason you're acquiring this is to improve your margins, to grow your business, not to have fragmented companies. So communication plans are essential.
That's great. So I'm going to ask Harrison a tricky question, a little twist here, but this is going to be something, I don't want to put you on the spot, but a lot of folks on this call are young entrepreneurs that have grown companies. I know, you know, some folks here have been involved in a number of businesses, but most of them are growing companies right now. Let's assume they bring an investor on, they bring a Kayne on. You start talking about acquisitions at a board meeting, but isn't it true also that you are looking at that management team? You're saying, look, are they capable of handling these integration issues that Baha talked about? Are they capable of putting these business together that Craig was talking about? Do they have, even if they haven't done it before, are they able to build this and be a part of this growth? Because let's face it, these folks running these companies, the Chris's, the Daves, you know, the Lori's, the Dons, I mean, they're thinking about those issues, and you got to be assessing them too, because you want it to be successful. How do you look at that, and how do you groom or train those people to become ready to be with a bigger company?
Yeah, no, that's a great question. So I would say the first thing that we would recommend is for your first acquisition, start small, especially if you haven't made an acquisition before. So probably not the best idea to, you know, if you're a $10 million ARR business, to be going after another $10, $15 million ARR business. Start with something small, 1 to 2 million of ARR. They have, you know, 10 to 20 customers, and prove that you can do it at that level, right? And then take that experience and leverage it with some larger opportunities. So I think that's kind of key. And then I would also say that having a plan of action up front before you really decide to dive deep into an acquisition is important. I can't tell you the number of companies that come to us and say, well, guys, we want to make an acquisition. And then we say, okay, so who are their customers? How many of them can we upsell? How many of our customers can we upsell on their product? And how many of your customers do you expect to lose? You know, what are some of the expenses we're going to be able to cut? Who are we going to need to keep on? Who's critical? When our entrepreneurs come to us without a lot of that figured out, I think it immediately raises a red flag saying, hey, you know, we probably need to slow things down a little bit, think through all these strategic implications before we go gung-ho into an acquisition. And so we really try to be a good partner in helping our portfolio companies think through a lot of these key questions. And also, I think a big benefit of being a part of a broader portfolio is we can also introduce some of our CEOs to other CEOs in the portfolio and have them walk through some of the challenges and the pitfalls and things that they've gone through, which I think, and that goes beyond just M&A, but I think that's something that, when you partner with a firm like ours, you get access to a kind of brain trust of other CEOs who can really walk you through a lot of those challenges that they've been through as well.
Yeah. So let me ask you, we have time for a couple more questions, and this is some practical ones that Craig and Baha, I think the people are interested in. So you both made acquisitions outside of your home territory, Chattanooga and Atlanta. Baha, I think yours Texas and California, and Craig, you look at all over the place. How important is it to bring people in and say, now you're going to be part of the mothership, come to Chattanooga, come to Atlanta? And how challenging is it to run a business where you got multiple remote offices? And by the way, it may have been more challenging pre-COVID than it is post-COVID. But Baha, you're looking at the mid-market America and West Coast. How'd you do it?
We were clear also, just like we don't know how to run multiple platforms and multiple servers and places. We were clear that we want to downsize. So in California's case, we were intentional not to have an office, and actually way before the diligence, that's something I discussed with the seller, and that, hey, don't renew lease, let's stay, keep it everyone at home. And the Texas one as well. We're intentional, and we're clear to our team in Houston, Texas, that we are downsizing that office. But we've had multiple times where that face-to-face is so important that, and now we just have to do lots of Zooms. But one key point I want to mention on acquisitions, it's so important that you, after acquiring a business, to have a set of KPIs to track the acquired business separate from the mothership. I can't tell you how many mistakes we've done in the first acquisition because we were not thoughtful and intentional about keeping the metrics around the acquired revenue in a separate bucket, rather than just going back and one by one trying to peel off that what it would have looked like. So that's my last tip is make sure that your acquired revenue and acquired KPIs are measured separately and all together as well.
We do it. We try to get on the negotiation, or at least the initial stages, we try to get the founders or the owners of the companies, the principals, to come to Chattanooga, simply because we have, I think, an incredible culture and headquarters, and I think it's impressive. It also gives us an advantage because, for us, they know that their company is going to be well taken care of. A lot of resources, a lot of infrastructure, good culture. You can sense it when you walk in a place that it's not stuffy. Everyone is having fun, enjoying working here. So I think that sends the right message to the founders that they know they sort of are parking their business in the right, their baby in the right place. The other thing is, after, we try to bring the team in so that they get a sense of the culture, because we don't want their culture being our culture. We don't want them to hold on to their culture. That is a thing that we've had to sort of work through, is make it clear that, hey, we're buying this business. We want you for your, intellectual resources, your abilities, and your products, but this is our business. This is the business that you're a part of. And while we respect the brand and have maintained the brand, over time, we want them to merge into our culture. So it's important that they come and visit with us and the rest of the team, and they understand that they're a part of it. And when we bought American Shipper, we saw this. Editorial people especially have brand identity. They work for such and such publication. We actually had 2 folks that within the first week left. And that was a blessing in many ways, because they were not willing to make that transition. And so because of that, it worked out really well for us.
Great input all the way around. I think we could talk about this topic for another 5 hours. It's been very insightful. Baha, what you've done at Azalea, bringing 3 acquisitions together in different sections of the country, growing the business, and frankly, moving it from Valdosta to Atlanta. And that whole process was amazing. Craig, what you've done there at Freight Waves, bringing together the various media sources and building a company in Chattanooga and the importance of culture. And Harrison, your focus, obviously, in helping these companies grow. A couple of quick takeaways. I think you both highlighted the fact that putting the right kind of performance criteria in place, whether that's earnouts or something else, is critical. Baha, you pointed out the fact being able to measure those KPIs for that company, especially if there's any, they're tied to performance, is really important. So understanding what those are. Harrison, great point about starting small. A lot of folks on this call not made acquisitions before. Start small, but be in a position where you sort of learn the process as you go through that. And then the role, Craig, you pointed out, which is effectively having an investor like Kayne that's like your VP of business development, somebody that's out there that can do a lot of the legwork that, you know, you don't have the resources internally to be able to do. Really important.
And you can use them as the bad guys in negotiation. And we've seen that firsthand. Is I can't match this number because Harrison won't let me. So I'm picking on Harrison.
I've used my board for that all the time.
Yeah.
We're happy to do it.
Appreciate very much your time. Great discussion all the way around. I make a habit of making sure that we start on time and end on time, and we're right at 1 o'clock right now. So again, thank you, Kayne. Thank you, Azalea. Thank you, Freight Waves. We wish everybody success and hope you have a wonderful holiday season.
All right, take care. See you.
Thanks,
Thanks, John. Bye.
Bye.